Hi, everybody. My name is DJ Wright. I'm our investment manager here at Financial Freedom, and I hope you're all having an amazing night at the Aquarium. We appreciate all of you, and that's what this night is all about. So thanks for being here. I'm sad that I couldn't be there in person, but I at least wanted to show my face. And given that we're your advising team, we think it's important that we do provide you with education whenever we can. And so we wanted to just do a little market update. There's a lot going on, as there always is in the economy and the stock market. So we at least wanted to, touch on a few things here just for a few minutes. So thanks for being here. The last 3 years have been a wild ride. Going back to 2020, the pandemic, and actually the shortest bear market that we've ever seen. And then when we look to last year, we had kind of the real downturn that actually, lasted a while, and we're still kind of working through all that. And although we've made a lot of progress, which we'll talk about here, but when you look at last year, coming off the pandemic, we saw inflation just really shoot through the roof. Last summer, it was at 9%. So some of the highest we've seen in a long, long time. And I know that, we all can really see it and feel it personally. And so the Federal Reserve, they started raising interest rates last year to try to counter the high inflation that we had. So the Fed's job is to keep the economy moving at just the right pace. Not too hot, because then we get inflation, but not too slow because we're not moving forward and growing. So there's a sweet spot. And interest rates are their best way of kind of either slowing the economy down or encouraging the economy along. And so last year, with rates very high, with inflation very high, they started raising interest rates very aggressively. I mean, they went from essentially 0 to 5.5%, and that's a big headwind for the stock market. So a lot of the downturn that we saw last year, some parts of the market were down 20 to 30% last year. It was because of higher inflation and then an aggressive Fed that was raising rates to try to counter that. Well, this year has been much better. We're still not out of it yet. We still haven't recovered fully, but we have made a lot of progress. We actually entered a new bull market, which is always exciting. And a lot of the reason that we've seen a better year is the opposite of last year, right? Inflation has come down. So inflation, again, 9% last summer, and it's now just under 4%. And so if you see here, if we look at the United States, these are our year-end projections. All these numbers are pretty close as of today, but you can see in the middle there, the CPI, which is an inflation reading. We're predicting it to be around 3.8%, which is, again, kind of right where we're at right now. So we've made huge progress bringing inflation down. And the good news is that the economy has actually held up quite well. Remember that the Fed is trying to slow the economy down. And, we're hoping for what you've probably heard, that soft landing, which basically means they can get inflation down without throwing us into a recession. And so far, they've done a good job. You can see the GDP growth year over year. This is, again, our projection end of year would be 1.2%. And the unemployment rate of 3.7%. So pretty low. I think we're right at 3.8% was the most recent unemployment rate. So again, inflation has come down, and we haven't seen major economic hardships, right? Unemployment rate low, and we're still seeing some decent growth. And so, kind of where we're at now is, well, how do we get us across the finish line? So the Fed's inflation target is 2%. That's what they would like to get it down to. And so they, their job is not done. They did kind of the easy part, where they've been able to slow things down and really get it off those huge spikes that we were seeing. But how do they get us down to that 2% without throwing us into a recession, or at least, slowing things down significantly. And that's something that we don't know how it's going to pan out. We're hopeful that they will be able to get it back down without throwing us into a recession and accomplish the soft landing. That's the ideal scenario. But it is possible that we could see a mild recession. And if we did, again, we don't expect anything deep and anything lasting a long time like in 2008. It would likely be a minor contraction, and then we kind of move on from that. So we're in that waiting period where we will kind of have to just see what happens and wait for the data and things like that. I also wanted to mention that lately there's been a little bit of a pullback. So the last few months we have seen that, and there's a couple of reasons for it. I mean, one, there is just the seasonality. September's historically the worst month for the stock market. August isn't too great either. So, sometimes the markets can get in a sour mood just because it's August and September. So that's part of it. And also, the Fed has come out lately saying, look, we'll do what we need to do to get inflation down to 2%. That is the most important thing. And so they've hinted that they could hold rates higher for a little bit longer than the markets were hoping or expecting. And again, higher rates means a little bit more of a longer headwind for the markets. So part of that has caused us to pull back a little bit. It hasn't been anything too major, but again, there's going to be some bumpiness as we continue to kind of move past that final phase, right? We're like 80% of the way there, and how do we get that last piece completed? There's going to be some ups and downs. The end of the year, though, historically actually is a positive for the stock market. It's actually usually a pretty good part of the year. So hopefully that pans out again this year. You also maybe have heard lately about the shutdown. That's been big news. When you look at its effect on stock market performance, there's really nothing to be concerned about there. The markets have actually been positive most of the time when governments have shut down. So, we're always doing this dance, this politics, right? We're kind of used to it now, but remembering that the stock market is, it's thousands of companies that find ways to make money no matter what the economic environment is. You can see here that the United States is actually faring pretty well compared to other parts of the world as well. You can see our inflation rate is the lowest, the CPI. We have pretty good GDP growth, and the unemployment rate is also pretty low compared to other parts of the world. So I think it's important that we talk a little bit about some historical trends. I'll start by saying that, of course, no one knows what's going to happen in the stock market. We can't predict things, and we can look at history and see, what we've done in similar economic times, but nothing repeats itself exactly, but tends to rhyme. And when you look at past times where we have entered a new bull market, so for this time, October of last year was the low point. And in early June of this year, we recovered 20% off of that low. So we recovered 20% in the market. And that basically triggers a new bull market. That tells us, hey, we're in a new bull market. So when you take the date that we hit that new 20% bounce off a low, so for us, it'd be early June, and then you look 3 months, 6 months, and 12 months off of that date, the stock market performance has been great. So you can see 3 months later, the average gain has been 5.1%. And remember that this is on top of the 20% that we already recovered. So 5.1%, and we've been positive 83% of the time. So we've actually already passed the 3-month mark. So again, these are all from early June. So 3 months later would be early September. And I think we're actually pretty close to this number. I think off of the early June where the S&P was to early September, it was maybe a 4 or 5% gain. So it actually held true here. We have pulled back again since that, but looking 3 months out from early June, we were right on track. 6 months out, the average gains have been 12.7%, and we've been positive 75% of the time. So we'll be coming up on 6 months here in a few months. We'll see where we're at. But that could be promising, could tell us that there could be some gains here towards the end of the year. And when you look 1 year out, we've seen average gains of 18.9%, and we've been positive 91.7% of the time. So this would be early June of 2024. So again, these are definitely optimistic trends here. And again, like I said, we don't know what will happen, but it's always good to look at how things have happened in the past when we've been in similar situations. Let's talk about bonds. So bonds had the worst year that they've ever had last year. And that's because when interest rates come up, you see bond prices go down, and rates came up very aggressively last year. And so we saw bond prices go down significantly, something that we had never seen before. And, bonds are typically your conservative, kind of your counter to when stocks are bumpy, you can lean on your bonds. And so last year was extra tough because we had stocks and bonds go down. Well, the good news is from where we are now that rates have come up, bonds actually look pretty good. So one, you can actually make some money on them because interest rates are higher. And two, if the Fed eventually does start cutting rates, which we do expect at some point, that can cause bond prices to go up. So if you've been invested in bonds and you're saying, why would I keep these? Now's not the time to sell those. If you look here in past times where we've raised rates, similar to what we just recently have gone through, the bond returns have been pretty great coming off of that last rate hike. So the average, let's just look at over on the right side of this. The average 6 months after the last rate hike, bonds have gained 8% on average. So pretty good for bonds. When you look a whole year out, the average gain has been 13%, which is, that's like stock market numbers, but with bonds. And when you look over the next 3 years, the average annualized gain has been 10% for each of those 3 years. That is stock market type gains. So, the Fed, they did not raise rates this last meeting for this month. They'll be meeting again early November. And there is a chance that they do raise rates again. They're going to definitely be data dependent. So we'll see what happens as far as the inflation numbers and things like that. But we may have seen the last rate hike. And so then this would come into play here. If they do raise rates again, we know they're near the end. So that's something that we don't know for sure when the last one will be. It's likely that it already passed, but it is possible that we do see another one. Either way, we're near the end of this rate hiking cycle, and that can be pretty good for bonds going forward. And it's important as we really sometimes get sucked into the here and now, what's going on in this economy, what's going on in the world now. And I think it's important to zoom out and look at the bigger picture. It's always very telling, and it can remind you that investing in the market is a longer term deal. You can see here that there's lots of ups and downs along the way. That's just the way the stock market works. We all wish it went straight up, but it doesn't. But the volatility is the price that we pay for the long-term success that the stock market has shown us. But you do have to be patient and stick to your plan. So if you look here, the two blue lines, these are your small stocks and your large stocks. Small stocks have averaged almost 12% per year from 1926 through 2019. So great returns, but yes, there's definitely years where you're saying, okay, how can they return well over time? They're down 30%. Well, it's usually just temporary. If you stick with it, if you had stuck with it that whole time, you'd see a 12% per year with your small cap stocks. And your large stocks have averaged just about 10% per year. So if you look at this, look, $1 turned into $9,244 for your large cap stocks. Small caps, $1 turned into almost $40,000. Pretty amazing. But again, you can see the ups and downs. You can see 2008 there. You can see the Great Depression, and you can see all of them along the way. Volatility is normal. It's not easy, but it is part of the investing experience. And if you look at the orange line, these are your government bonds. So these are the more conservative investments. And you can see that here where you don't make as much over time, but it's a smoother ride, not as many ups and downs. Take a look at 2008. You can really see the downturn with the stocks. And of course, with bonds, it's a different story. So there is some volatility with bonds. You're going to see some movement, but it's much more conservative and stable than your stocks are. So, what should you own? I mean, it depends on your timeline. If you're somebody who's got a while till you're going to use that money, you really should be focusing on the blue stocks, the blue lines. If it's money that you're going to be using soon, or you're getting close to retirement, or you're in retirement, then you probably want to have some things in the orange line or the green line, but maybe not all of it, right? Sometimes if you're retiring and it's, hey, I'm going to use some of this money, well, some of it is still longer term if you plan to live a long time in retirement, and so you can keep some of that money invested for growth. So that's what we help you do, is figure out how much to have in these different buckets so that you have a investment portfolio that's just right for you. Last thing I'll point out, you can see the inflation line here. It's the gray shading. So $1 turns into $14. So with all of these, they've all outperformed inflation, where of course money sitting in the bank would not. So good to keep in mind. The last thing I wanted to share here is it's similar to what we just saw, but in a little bit different format. So this goes from 1970 through 2022, and it's the growth of 10,000. So if you invested 10,000 in 1970, it'd be worth 2.2 million. And what's amazing is you can just see here all the various events that happened along the way. So many things in the United States, but in the world. And of course, we have a lot that's going on right now. We all know that. But at any point in time, there's always a lot going on. And one thing, with the stock market is, it's shown us that it keeps going up. Yes, there's going to be those initial reactions and the short-term volatility, but over time, the stock market, if you're well diversified, it's recovered from everything, and not just recovered, but continued to grow. So I would keep that in mind. You don't want to trade your accounts based on headlines. There's always going to be headlines. There's always going to be fear that's being sold to you. Be careful, getting too caught up into it and allowing you to make changes to your accounts based on that. We found that you're usually better to stay the course. Remember that you got a longer term plan, and that's going to give you the best chance for success. Of course, easier said than done, absolutely, but that's why you have us. So we're always here to chat with you. If you're concerned about something, or you just want to ask some questions or review anything, we've got a whole team of advisors here that are always available, and we'd be glad to chat through anything that you need. So that is what I have for you all today. Again, thanks for joining us here for this brief market update. If you heard anything and you do have questions, again, we'll be able to answer those here right in a few minutes. And I hope you guys have a great rest of your time at the Aquarium, and I hope to see all of you very soon. Thanks so much. Bye-bye.